Bitcoin versus gold. Which is the better store of value? Imagine waking up tomorrow to news of a global financial meltdown. Markets are crashing, currencies are devaluing, and economic uncertainty is everywhere. In that moment, you ask yourself, where is my wealth safest? Is it in a heavy, shiny bar of gold, or in a series of cryptographic codes secured on the blockchain? This is not just a theoretical question. It's a decision that investors around the world are grappling with right now. Gold has a long history. For over 5,000 years, it's been the ultimate symbol of wealth. It has survived empires, wars, depressions, and revolutions. It's rare, beautiful, and universally accepted. But in 2009, a mysterious entity known as Satoshi Nakamoto introduced Bitcoin to the world. A decentralized digital currency with no borders, no central authority, and a strict supply limit. Since then, Bitcoin has grown from a niche experiment to a financial phenomenon, gaining the attention of retail investors, institutions, and governments alike. So now, more than ever, the question is relevant. Which asset is better suited for preserving your wealth in the 21st century? To answer that, we need to understand what makes something a store of value. There are 5 universally accepted criteria: durability, portability, divisibility, scarcity, and recognizability. Gold passes with flying colors. It doesn't corrode. It can be carried and traded. It can be melted and reshaped. It's relatively rare, and it's recognized around the globe. Bitcoin, surprisingly, also meets these criteria, sometimes even exceeding gold in certain areas. Bitcoin cannot be physically destroyed, can be moved globally in seconds, divided down to 100,000th of a coin, is provably scarce, and increasingly recognized in global financial discussions. Let's talk about scarcity. Gold is rare because it's difficult and expensive to mine, but it's not finite. New gold reserves are discovered and extracted every year, adding to the global supply. Bitcoin, on the other hand, has a hard-coded supply limit. Only 21 million coins will ever exist. This number is immutable, enforced by thousands of nodes across the world. Furthermore, Bitcoin's issuance rate is halved approximately every 4 years, a process known as the halving. This built-in scarcity is unlike anything in traditional finance and adds a unique layer of predictability and deflationary pressure. Now consider portability. Imagine trying to carry $500,000 worth of gold across international borders. Not only is it physically burdensome, but it exposes you to customs, taxes, and even seizure. Bitcoin solves this problem elegantly. With nothing more than a private key, a 12-word seed phrase, you can store and transfer millions of dollars instantly, securely, and without intermediaries. No one can confiscate it without your permission. It's weightless, invisible, and resistant to censorship. In a geopolitical crisis or emergency, this level of mobility becomes more than a convenience. It becomes essential. Security is another crucial factor. Gold has to be stored in physical locations, vaults, safes, or banks, all of which come with costs and risks. It can be stolen, lost, or even nationalized in extreme circumstances. Bitcoin, in contrast, can be stored in cold wallets, disconnected from the internet, and virtually unhackable if managed correctly. However, this digital freedom comes with responsibility. Lose your private key, and your Bitcoin is lost forever. There's no helpline, no reset button. But for those who value true financial sovereignty, this is a feature, not a bug. Then there's the issue of volatility. Gold is famously stable, often moving slowly and predictably. It's a safe haven in times of turmoil, and that's why central banks still hold it in their reserves. Bitcoin, by contrast, is notorious for its price swings. A 10% daily fluctuation is not unusual. This volatility can scare off conservative investors, but it also presents significant opportunities for those who understand the cycles. Bitcoin's price history shows repeated boom and bust cycles, often linked to the halving events. For long-term believers, this volatility is simply part of the journey toward broader adoption and higher valuation. Historical performance is also a powerful metric. Between 2000 and 2024, gold's price increased approximately 600%. That's respectable. But Bitcoin? From 2009 to 2024, it has appreciated by over 2,000%. That's a level of growth almost unimaginable in traditional markets. Of course, early Bitcoin investors took huge risks, but even latecomers have seen substantial returns, especially those who held during volatile periods. Gold has preserved wealth. Bitcoin has created it. And as the world becomes more digitized, the appeal of digital assets is only growing. Institutional acceptance is another frontier. Gold is entrenched in global finance. Central banks hold it, and it's traded globally. Bitcoin is newer, but gaining momentum fast. Companies like Tesla, MicroStrategy, and even nation-states like El Salvador have embraced it. Financial giants like BlackRock and Fidelity are offering Bitcoin exposure to clients. The momentum is undeniable. Bitcoin is no longer a fringe asset. It's becoming a pillar of the modern digital economy. In fact, Bitcoin ETFs are being approved in major markets, adding a level of legitimacy that seemed impossible just a decade ago. Beyond the technical and financial comparisons lies a deeper, philosophical divide. Gold represents stability, tradition, and the physical world. Bitcoin embodies decentralization, disruption, and the digital future. Gold is mined from the earth. Bitcoin is mined from code. Gold is controlled by banks and governments. Bitcoin is controlled by math and consensus. The question is no longer just about returns. It's about what you believe the future will look like. Do you place your trust in physical wealth or in decentralized, incorruptible technology? There's another aspect we must explore: utility and adaptability. Gold has limited industrial use, mainly in jewelry, electronics, and dentistry. Its value is largely symbolic and historical. Bitcoin, however, is programmable. It operates in an ecosystem where smart contracts, DeFi, decentralized finance, NFTs, and digital identity solutions are being built. It's not just digital gold. It's a building block for a new internet economy. This gives Bitcoin a multidimensional utility that gold cannot match. Also consider demographics. Younger generations, millennials and Gen Z, are more likely to invest in Bitcoin than gold. They grew up in a digital world, and many of them view Bitcoin as the natural evolution of money. This generational shift could influence long-term trends in capital allocation, with more wealth flowing into digital assets as these groups grow older and wealthier. Let's not ignore regulation either. Gold operates in a mature regulatory environment. It's taxed, monitored, and widely accepted. Bitcoin, being new, faces evolving regulations. This can be a risk, but also an opportunity. Regulatory clarity, once achieved, could unlock massive institutional inflows. We're already seeing signs of that with spot ETFs and licensed custodians entering the space. Another key difference lies in transparency. The Bitcoin blockchain is fully auditable. Every transaction, every wallet, every movement is visible. Gold, on the other hand, lacks this level of transparency. You don't really know how much gold a central bank holds. You take their word for it. Bitcoin doesn't require trust. It relies on math and open code. One more important dimension is environmental impact. Critics often highlight Bitcoin's energy consumption. It's true that the Bitcoin network uses electricity, but it's increasingly powered by renewable sources. More importantly, Bitcoin's energy usage is transparent and measurable. Gold mining, by contrast, leaves irreversible scars on the environment, from toxic waste to deforestation. The environmental debate isn't black and white, but it's essential to consider when choosing your store of value in an environmentally conscious era. So, which should you choose? If you want steady preservation of value, gold remains a solid choice. If you're seeking exponential growth and embrace technology, Bitcoin offers a compelling case. But perhaps the wisest choice is not one or the other, but a strategic mix of both. Diversification is, after all, a timeless investment principle. Having exposure to both assets can protect you from a wide range of future scenarios, from inflation and currency devaluation to technological upheaval and digital transformation. Now let me share something that very few people realize. And it could be your edge in this game. Bitcoin's halving cycle creates a unique pattern. Historically, each halving has triggered a major bull run within the following 12 to 18 months. The next halving is set for April 2024. This isn't a random coincidence, it's a coded supply shock that reduces the flow of new coins into the market. As supply tightens and demand increases, prices have surged in the past. Savvy investors don't wait for headlines. They position themselves before the wave hits. But here's the extra insight most miss. During the months just before and after a halving, Bitcoin dominance tends to rise, meaning it often outperforms altcoins significantly. If you're rotating your portfolio, timing that dominance shift could amplify your gains dramatically. Prepare now or pay later. The choice is yours.